Investing in mutual funds is a popular way for beginners to get started in the world of investing. A mutual fund is a type of investment vehicle that pools money from many investors and uses that money to buy a diversified portfolio of stocks, bonds, or other securities. This allows investors to diversify their portfolio and invest in a wide range of assets without having to buy each one individually. One of the main advantages of mutual funds for beginners is that they provide professional management. Most mutual funds are managed by experienced investment professionals who have a deep understanding of the markets and know how to select investments that have the potential to provide strong returns. This can be especially helpful for beginners who may not have the time or expertise to manage their own investments. Another advantage of mutual funds is that they offer a high level of liquidity. This means that investors can easily buy and sell shares of the fund, typically through the fund company or a brokerage firm. This can be especially useful for beginners who may not have a lot of money to invest and want the flexibility to withdraw their funds if needed. When choosing a mutual fund, it's important for beginners to consider the fund's expense ratio. This is the annual fee that the fund charges to cover its operating expenses, such as management fees and marketing costs. A fund with a high expense ratio may not be the best choice for beginners, as it can eat into their investment returns over time. Instead, they may want to look for a fund with a low expense ratio to help maximize their returns. One of the top mutual funds for beginners at the moment is the Vanguard S&P 500 Index Fund. This fund tracks the performance of the S&P 500, a widely followed index of 500 large-cap U.S. stocks. The Vanguard S&P 500 Index Fund is a passive fund, which means that it simply seeks to replicate the performance of the index rather than trying to beat it through active management. This can be a good choice for beginners who are looking for a low-cost, diversified investment. Another top mutual fund for beginners is the Fidelity 500 Index Fund. Like the Vanguard S&P 500 Index Fund, this fund tracks the performance of the S&P 500. However, it is actively managed, which means that the fund's managers attempt to outperform the index by selecting individual stocks they believe will do well. While this approach can potentially provide high returns, it also comes with the risk that the fund may underperform the index. In addition to these index funds, beginners may also want to consider target date mutual funds. These funds are designed for investors who have a specific time horizon, such as retirement, in mind. The fund's asset allocation is automatically adjusted over time to become more conservative as the target date approaches. This can be a good choice for beginners who are just starting to save for retirement and want a simple, hands-off investment option. No matter which mutual fund you choose, it's important for beginners to keep in mind that all investments carry some level of risk. It's important to diversify your portfolio and not put all of your eggs in one basket. It's also a good idea to have a long-term investment horizon, as short-term market fluctuations can be unpredictable. By following these guidelines, beginners can get started on the path to building a strong, diversified investment portfolio.